unconditional EU antitrust approval, clearing the way for its $1.4 billion acquisition of the company. Joining us for more is Bloomberg's Alex Semenova. If John were here, he would say, why do we want Roomba going around tracking all of the data in my home and transmitting it to Alexa and transmitting it to Amazon? Nonetheless, Alex, what do we got?
Exactly, Lisa. Well, investors are apparently really happy about it. Shares of iRobot were up as much as 44% before the open, now moving higher again as the stock market opens. This is after reports that Amazon is set to win unconditional approval from the EU for its acquisition of the company, which is, of course, the maker of household appliances like the popular Roomba vacuum. This deal was announced back in the summertime. Amazon said it would acquire the company for $1.4 billion to expand its portfolio of smart devices, which includes the Alexa voice assistant, various smart thermostats, security devices. But the EU had warned Amazon that this deal could reduce competition in the robot vacuum cleaner space and importantly reinforce Amazon's position as the dominant online marketplace in the U.S. The company has been under scrutiny along with other big tech names for their acquisition of smaller rivals. So this would be a big win for Amazon if approved. The initial agreement worked out to about $61 a share. That was revised down to $51.75 a share back in July after iRobot's net debt increased. You can see iRobot moving higher today, but of course, trading volume is light, so it is accentuating that upside move as well.
Alex, thank you. Thank you so much for that. And finally, attention turning to consumers as Black Friday gets underway this coming after a number of retailers delivered disappointing earnings and tepid outlooks for the holiday season. Joining us for more is Bloomberg's Simone Foxman. Simone.
Yeah, Lisa, Black Friday just isn't what it used to be, and that was the message from CEOs this quarter. Macy's CEO Jeff Gennett saying on his earnings call just a few days ago that Black Friday is really focused on the deals prior to Black Friday. Retailers have been promoting this day and this week since early November, and this strategy allows really budget-constrained consumers to kind of spread out their spending over time. Bloomberg Intelligence also says expect a day where people are just going to be putting less in their baskets. The biggest discounts, however, are going to be on toys, with discounts there up to 35%. These discounts, though, even though there's this real emphasis on this value-oriented consumer, are not expected to be as significant as last year. That said, we're going to see the likes of Lowe's offering enormous discounts on things like big appliances, as that spend has really been under pressure. Overall, the National Retail Foundation expects that we'll see holiday sales increase 3 to 4% this year. This is not as big as last year, but it is roughly in line with what we saw pre-pandemic. Again, shares of most retailers this morning in the green, led in part by Costco, but not much movement here today, Lisa.
Simone Foxman definitely wraps it up well. Thank you. UBS Wealth Management's Leslie Falconio unveiling her outlook for the consumer, writing, quote, "We expect consumer spending to slow into 2024 with the savings rate set to rise. Consumers will spend more selectively." Leslie, I am so pleased to say, joining us now with more. Leslie, how important is Black Friday? Are we overstating it at this point, given the fact that we also have Cyber Monday, the Friday before Black Friday, and every day leading up to it online and elsewhere?
I definitely think it's an overstatement now versus what it used to be. I mean, a lot of these shopping has been going on for the past, month now. It's not just about Friday. And, I do think, it was mentioned before, we are expecting to see some slowing this year versus last. And, versus the 5% growth that we saw last year, we might see around 3 to 4% this year because people have other obstacles coming, such as student loan debt.
Well, this is the reason why some people are expecting some sort of slowdown or a gentle kind of Goldilocks softening in the consumer appetite that can lead to a disinflation. I do wonder, though, you said people are going to be spending more selectively. On what? We have seen services pick up to such a big degree. Are we starting to see that fall off and people go back to goods?
Well, listen, I don't think necessarily they'll go back to goods. I think people will start spending more selectively, particularly when you think about that student loan debt. You might not pay as much for that concert ticket as you were, this past year. And I do think that consumers are going to start saving a little bit more as we go into 2024, particularly given our view is that, the Fed more than likely will not ease in the first half of the year. And we know that there's a lag for this higher for longer. And I do think that this headwind of higher borrowing costs and just impact to the consumer will steadily hopefully, increase in 2024, and people will just start to be a little bit more selective of how they spend their money.
How concerned are you about what Walmart was talking about, that in the past 90 days they've seen a significant drop-off in consumer appetite? Does that translate to other types of retailers, or is this more specific to exactly what Walmart is dealing with?
Well, Walmart's going to be more of the coupon clipping kind of. They've seen more of that. I mean, I think that when you look overall, as much as inflation's been going down, the actual price level is still fairly high. So I do think that, you're going to see some headwind going forward in terms of that kind of spending, and these kind of deals that you're going to get going forward will also increase. We've had a situation where the consumer's been incredibly resilient, and we think that that continues. I mean, household balance sheets we view as still very strong and will continue to be strong. We just do expect that, savings rate will probably move higher as some of the stimulus goes by the wayside. You do have some of the things such as this student debt, playing an obstacle in terms of how you spend your money, and we still have an inverted yield curve. So we do anticipate that the consumer might pull back a little bit. I mean, we still expect a soft landing, but again, savings is probably going to increase over the next year.
Okay, so there's a question around savings increasing and savings decreasing, right? So people have been saying, well, people are eating up their bucket of savings from the pandemic, and that's the reason why they're going to slow down your spending. You're taking the opposite tact and saying that actually they're going to be more prudent as they try to rebuild. Which is it, right? Because there's some people who sort of represent Americans as profligate spenders who are just, banking on their credit card and just carrying on with the spending.
Well, I think you're absolutely right. I mean, credit card debt, as you know, is like $1 trillion, and we've seen these credit card rates, right, of 21%, which is incredibly high. And we are seeing a rise in delinquencies. I do think there'll be a level of prudence next year in terms of the consumer. Again, I mean, they're still very strong. They still have, a strong balance sheets. But we do think that that saving aspect will probably be a little bit more in tune next year as we do see, growth kind of slow. And again, this impact of higher rates continuing, as we believe that they will, particularly during the first half of the year, start to impede the consumer a bit.
Do you buy all of these arguments, taking a look at Thanksgiving dinners and saying, well, actually, it's lower price on average than last year? Do you think that that really represents kind of how people are feeling and how they're going to experience disinflation?
I don't. I mean, because they're still, again, prices are still high, and I think that, listen, I think, as mentioned before, George mentioned this when you look at some of these indicators about the delta, about the change, and that is incredibly important. But as an absolute level, these levels are still very high. And although I don't think it's going to change someone's spending habit because they're seeing a slight decline right now, because there's other obstacles that they're going to be facing, such as student loans.
Leslie, you'll be sticking with us, and we are looking forward to that. Coming up, OPEC pushing back, a critical meeting, clouding the outlook for production. That conversation coming up next.
right now we see that the market is trading comfortably in, okay, it's low volumes, but spreads have held up in the last few days, and we think physical buying is going on in the market. So the next question, though, is about that January number. So will the demand be there, and is OPEC happy for the U.S. to fill that excess demand? We think the demands can be there, but will OPEC want to hold back with their own customers and allow them to buy American?
Nadia Martin-Wiggin of Spellin Capital weighing in on the energy markets. Oil sliding into its third day of declines on OPEC Plus, announcing a delay to their pivotal November meeting, which will now be held online. The group struggling to strike an agreement on African output quotas. For more, Alaric Nightingale joining us from London. Let's talk first about the OPEC Plus meeting. Do we have a greater sense of why it's been delayed and why it is remote and what that signals for production?
Well, it's not completely clear why it's remote. The cause of the delay, we think, is there's a disagreement with how much they want the African countries, Angola and Nigeria, to pump. And they're just trying to kind of work out what they should do and what's a reasonable amount. And that's obviously pretty important for the group at large. And if they don't kind of find those agreements, then that's just going to cause things to drag on.
Alaric, thank you so much. We're getting some breaking news right now. We appreciate the insight, and we will follow up with you. We are getting U.S. PMIs. They're just crossing the terminal, and they are interesting that they come in below expectations on the manufacturing. So they come in at 49.4 in contraction territory, which is usually below 50 from the expectation of 49.9. And you can see that services actually comes in better than expected. So this is sort of the interesting point, is you still see expansion in the services sector, 50.8. So the overall still positive, still led by services, even with manufacturing disappointment. All of this kind of pointing to a real kind of turn beneath the demand. S&P futures just lower by about 0.1%. You could see that kind of drag on things. I imagine that you have a bit of a pop in yields on this, given the fact that people are looking at demand kind of continuing. You are seeing a bit higher 10-year yields, 4.47%, basically in line where they were before. The 2-year yield climbing up, bumping up, approaching that 5% level again, 4.94%. Bloomberg Simone Foxman joining us with more details. Simone, what are you seeing?
Yeah, as you were talking about, Lisa, the real strength here in that services sector number, we had expected that it would stay in expansionary territory, and we didn't really expect any major changes in either direction. But we can see just in the last few moments, NASDAQ, S&P 500, both turning into the red, whereas Dow Jones still holding up here. But the major moves, as we're seeing across the market, really concentrated in that bond space, with yields rising. Not too much happening today in anywhere in the stock market.
Simone, I love it. Every conversation, nothing's really happening, but we're going to tell you kind of what should be happening today on a day when pretty much no one is in the office. Simone, thank you so much. We really appreciate that. Leslie Falconio is back in the office, or at least back with us, probably not in the office on a day where not that much is happening. And just ripping up the script, as Tom would say. Are we seeing basically nobody in the office, everybody just basically punching in to make sure nothing is really exploding and then just moving on?
Yeah, it's fairly quiet. I mean, everyone knows that these kinds of days aren't actually the most liquid days, and we do have an early close. So I think that people are watching it, but normally on days like today, when the liquidity is pretty, prominent, you don't want to trade on these kind of days anyway. So it's fairly quiet.
Which is what we're seeing for sure in the price action as well as just in volumes. But I am wondering, we were just talking about the PMIs that came out, and it is interesting to show that is continuing, with services expanding more than expected and manufacturing contracting more than expected. Kind of goes to this feeling that we might see this trend continue for a longer period of time. Is that sort of being baked into your base case heading into next year?
Listen, I think that one of the biggest things right now that we are sort of pushing against is the fact that the market has, priced in an ease of the Fed of nearly 100 basis points in 2024. And although it's backed off a little bit from that March probability, which is now only about 15%, the probability of an ease in March was once 40% after that CPI number. That's really what we're pushing against. I mean, we don't think that the Fed has the ability to sort of wave the victory flag yet. And we do think that the Fed funds rate is going to stay higher for longer. longer throughout the first half of the year and most likely start easing in the third quarter. So that part of the market and what the market is pricing in currently, we think is a little bit too dovish, particularly in front of that December 13th meeting.
So do you get the sense that basically the Fed's going to be on hold for longer than people expect, but then that they're going to cut really rapidly? Or do you think that we have this sort of protracted higher rate environment that's going to become that much more challenging as time goes on?
You know, we're still in the soft landing camp, so we're not seeing that rapid cut yet. But listen, the fixed income market and the market as a whole, this is a show me market right now, right? So as much as the Fed can be vague in terms of wait and see, the fact of the matter is we have to wait and see for the data. But right now our expectation that the higher for longer will more than likely stay for the first half of the year, because although we think, you know, growth will slow and the payroll will start to loosen, we're not looking for these consecutive negative payroll prints that will force an aggressive easing. So we do think that, you know, in the second half we'll start to ease, but we think it'll be measurable. We don't think it's going to be this catch up because they've waited too long, at least from the data from what we're seeing right now.
What do you take in terms of the signal from oil prices and how much they've come in? A lot of people saying this is very much a demand story. Do you kind of buy into that, or do you think that there's another thing going on?
Yeah, I mean, listen, this is going to be like the fifth consecutive week of decline. I think the last time we saw this was in December of 21. Listen, our outlook is for oil to move higher into the end of the year and into next year. I mean, both on the demand side and from the supply side. So we don't think this is going to be something that lasts a long period of time. But again, you're right, this is the fifth consecutive week potentially that we'll see a decline.
I mean, do you think that this has to sort of reconcile itself either with oil prices turning higher or else the bond yield space coming in and going lower, bond prices going up, simply because it does suggest something broader?
Well, listen, I think that what we're seeing now in terms of, and you pointed this out earlier, I mean, you know, we have these break-even inflation expectations in the TIPS market that are already fairly low. However, as you talked about earlier, that five-year inflation expectation is still moving a bit higher. So I think that these lower oil prices are, in terms of the inflation going forward, could dampen a little bit. But for the longer term, we're not quite out of the woods yet in terms of thinking that could be a potential driver to inflation moving slightly higher. Also, as well, I mean, when things about the correlation of oil to things such as high yield market, the high yield market in terms of spread has continually compressed. So I think that, you know, going forward, at least, we do expect oil to go into at least the mid-90s by, you know, the end of the year into 24.
Leslie Falconio, thank you so much for being with us. Have a wonderful, wonderful holiday weekend. Let's take a look at some of the sector price action this morning. We have to find out what Simone Foxman is going to say is actually moving on a day when very little is moving, and I understand that. Simone, what do you got?
Well, I think the only sector that's really moving consistently in any direction is energy, where we're up over 1% in the broader sector. We are seeing some weakness in communication services, information technology, but I think, as has been the theme all morning, this is the Thanksgiving hangover. There's not too much going on in any direction, but we are seeing all 11 sectors up on the week. This is the fourth consecutive week of gains for the S&P 500. Bank of America was also out talking about some of the biggest inflows into stocks that it's seen in several weeks. So that important as we see some enthusiasm come back as we head to the end of the year, Lisa.
Simone, thank you so much. Coming up, the market moving events that you need to be watching. That's next in our Trading Diary. covers the open. I'm Lisa Abramowitz in for Jonathan Farrow. Not a lot going on in these markets today. You can definitely see the sort of holiday spirit imbuing markets with a sogginess and a lack of action. Not so much when you take a look at the yield space. Yield's definitely higher as people take a look at possibly more fiscal spending over in Europe, as well as the prospect that maybe people are spending and that things aren't so bad. Time now for the trading diary. What you need to be watching through the rest of the week. After the weekend, it's Cyber Monday. More spending, plus we'll get new U.S. home sales. Fed speak picking back up with Governor Waller and President Goolsbee. Wednesday, Dollar Tree earnings. Fed President Loretta Mester speaking, and we get the beige book. Thursday, we get some personal income and spending numbers, and finally ISM manufacturing on Friday, which should be interesting, especially given what we just saw with respect to some of the PMI data coming out showing the manufacturing downturn. I want to take a look at yields, and I really do think that this is actually one of the biggest takeaways over the past 24 hours. The fact that Germany wants to extend its ability to spend without having to come up with some net new issuance of debt. They want to keep competing, and you can see that has set the tone throughout the day. 10-year yields now near session highs, 4.47% after better than expected data in the services sector, as well as what's going on with developed markets continuing to borrow, continuing to spend, even into what could be a tricky period, but with a lot of debt and a lot of inflation. This was Countdown to the Open. Thank you for watching on this Thanksgiving Day. Have a wonderful weekend.
Because yeah, like
From the financial centers of the world, this is Bloomberg Markets with Alex Steele and Guy Johnson.
It's 30 minutes into the U.S. trading day on Friday, November 24th. Here at the top market stories we are following for you at this hour. Cards at the ready. Black Friday is here with consumers ready to spend a record average of $567 across today and Cyber Monday, according to Deloitte. We'll have more on the holiday shopping outlook with Jeff Gannett, Macy's CEO. On Cut Watch, traders and analysts are bracing for deeper supply cuts at OPEC Plus's postponed meeting next week. Christian Malik of J.P. Morgan was just in Vienna and joins us with his view. And truce in effect. The first pause in the fighting in the war between Israel and Hamas has begun, and Hamas has released 12 Thai nationals and 13 Israeli hostages. We'll bring you the latest. From Washington, I'm Kaylee Lyons with Guy Johnson in London. Alex Steele is off today. Welcome to Bloomberg Markets. Guy, happy Friday, happy Black Friday.
Yep.
Specifically, it seems a lot more people are probably out shopping than they are trading today.
Okay, so I've got two questions. One, did you really do the washing up? And two, have you bought anything yet?
Yes. And I have a cart that is full. I have not yet clicked the purchase button,
Excellent.
but I've been adding to the cart all morning.
You haven't executed the trade yet, but it's been
Yes,
filling up.
Exactly.
Okay. So when it looks like Kaylee's not concentrating during the show, we all know really what she's doing. I'm not suggesting that she would possibly do that, but maybe there's going to be an ongoing shopping theme throughout the show. Our question of the day is, what are you buying? Now that obviously has a multitude of different ways we can interpret that. We could do it from the market point of view, though it does seem as if maybe the buying's a little quiet today, or we could do it from a shopping point of view. But let's do it from our shopping point of view and get an idea of what's really happening out there. Joining us now, Bloomberg Technology co-anchor, though I think probably today Bloomberg shopping anchor, Caroline Hyde, joins us, and Andrea Felstead of Bloomberg Opinion. Caroline, let me start with you. You spoke to Jeff Gannett a little bit earlier on. Big day. What was he anticipating? How strong does he think it's going to be?
I think he's feeling pretty buoyant, optimistic. If you want to get the devil in the detail, he was saying cashmere, fine jewellery, it's going to be more luxurious items. It's people going out there and buying gifts on their gift list. They're not perhaps going for the more discretionary items that are just about self, but it is really about gifting at the moment. So look out for the more luxury. And of course, that's why Macy's wins out, because not only do they have the Macy's brand, they also have Bloomingdale's, Blue Mercury as well. So you can be thinking about beauty in that way. He feels very solid on his inventory. They got them placed in the right time at the right place, they think, whether it's omni-channel or if indeed it is the mall. And he sort of said, look, this is like a pilgrimage. There are still people who want to come in. They're racing in at 6 a.m. to get through the door. So he feels pretty confident that they got the right thing for a consumer that is at the moment fighting higher inflation, student loan debt coming back on. So he says it's a tough consumer outlook, but overall he feels pretty buoyant that he's got the right kind of thing for them at the moment.
Well, Andrea, to bring you in here, I wonder if that means people are going to go out, buy their gifts for this holiday season, and then that's going to be it for a while. That's it for that last burst of spending because the savings have drawn down, because there are student loans and all these other headwinds Caroline just cited. Is this it?
I think there is a real risk that could happen. I totally agree with Caroline. It's about buying gifts. It's about buying essentials that may be on offer rather than spoiling yourself.
So what does that mean in terms of the trend we can discern? What are you anticipating in terms of what the signal we can take away about the consumer, where they're spending, how they're spending? Is it on services? Is it on goods? What are the big kind of takeaways from this?
I think the US consumer is definitely weakening. I think the UK consumer is very mixed. So the nationwide figures this morning, by 9 o'clock, they were 9% up in terms of purchases, transactions compared with last year. That had slowed by 12 o'clock it was 5%, by 2 o'clock it was 4%. So it is really...
Right. So people have been out early and now they're fading it.
Yes, but don't forget we've got the whole of the weekend. But I think it will be a decent Black Friday. That does not mean it's going to be a great Christmas because I think they will have pulled forward spending to get the best deals. There was some data from some research from BCG and they said consumers were looking for at least a 30% discount.
So, Caroline, when it comes to that kind of pricing, obviously there have been holidays in recent history where because supply was so tight, there wasn't a lot of inventory. You didn't see deals like we used to see. Is it going to be big discounts? Is it big discounts at Macy's and maybe because consumers are a little bit more price sensitive this year?
All the signs seem to say about 30% off when I went in there a little bit earlier. So there will be deep discounting. I think, though, what's notable is we're seeing the sort of numbers that Andrew was talking us through, about 4%. Well, that's actually where the National Retail Federation here in the US think it's going to be about 2, 3, up to 5% year-on-year increase, which is the sort of growth that you anticipate prior to COVID. So it's sort of normalizing once again in terms of the increase year-on-year and how much people want to be spending into this weekend. And there's that natural ebb and flow. Like Jeff Gannett from Macy's was saying, look, yes, yesterday everyone was spending. Black Friday actually gets earlier and earlier. The competition brings it in early. So actually people might have already done their purchasing. But actually now there's going to be a lull post Cyber Monday. And then you ramp on up to the end of December ahead of the festive holidays and Christmas giving once again, guys.
Andrea, to pick up on Caroline's point, if that's the case, if that's kind of what we're seeing, that doesn't sound that dramatic in terms of any drop-off we're likely to see. I'm wondering whether actually if we're looking for signs of consumer weakness, it's not going to show up in the goods purchases. It's going to show up in, I'm not going to the restaurant. I'm not going to watch the Taylor Swift concert. I'm not going to do all of those service side things that I was before. Goods spending's already come down quite significantly.
I think there's a real risk to hospitality. I think there's an important factor that boosted last year. It was the first Christmas that wasn't interrupted or restricted by COVID restrictions. So we naturally had a bounce. So, and I'm not sure we're going to get that. I mean, in the UK last year, we had the strikes and we had some bad snow before Christmas, which depressed things a bit. We might get a bit of a lift. We're not going to have that automatic bounce. And I was talking earlier about lots of sequins in stores. And to me, lots of sequin jackets, lots of sequin dresses. To me, this is a real indication that retailers think that switch into party wear, that return to socialising is going to continue. And my money would be on the sale rails being full of those sequin items because maybe people didn't go out quite as much as
Kaylee, we've got a whole new economic indicator here, the sequin indicator. You heard it here first.
She said sequins, and I thought, oh, it's everybody who's going to see the Eras tour because everybody wears the glitter and the sequins to Taylor Swift concerts. And we actually know that that's a big thing that consumers have been spending their money on. But on the subject of spending money, I was taking note of the Adobe numbers that came out just within the last hour. They said already $5.6 billion was spent Thanksgiving Day. They expect in Cyber Week we're going to see $37.2 billion in online spending. That would be up about 5.4% year on year, which Caroline leads me to the question, Black Friday in a store, is that really where it's at, or is it doing what I'm doing in the commercial breaks and loading up a cart online?
I do think you're speaking my language now with a technology show, but we have seen, I don't know about you, many more people starting to use Instagram or social media as their means of actually shopping at the moment. You also have, of course, here in America, and particularly the competitive threat of Temu. I don't know about you, but Halloween was an absolute blast because of the really cheap options that they suddenly have brought. Yes, you have to wait slower in terms of the time in which you're going to be getting it delivered, but suddenly you've got some of these Chinese competitors coming in and actually taking Amazon, Walmart, and indeed, well, the likes of Macy's with their omni-channel offering for a run for their money. But I do think on a day like today, it's going to be a bit more of a in-shopping experience as well as in Cyber Monday, where you're all going to be back on your computers and doing it from a more omni-channel presence. But that's why every company has to be everywhere, basically, at once. You cannot just be all about malls. That's, of course, why Macy's is closing theirs, going for smaller Bloomies outlets or Macy's outlets and getting it outside of the mall a little bit more. Although he does say still really middle use in the department store as an offering.
That's interesting. Caroline, can we go back to what he thinks is driving the consumer right now and the strength that we continue to see? Does Jeff Gannett think that we are going to continue to see this as a reality into 2024? Our student loans going to have an impact. Our higher interest rates going to have an impact. I heard a really good stat from Gina Martin-Adams a little bit earlier on talking about the fact that only half of disposable income comes from earnings. The rest of it comes from the financial markets. If the financial markets roll over, what impact does that have on Bloomingdale's, etc.? What does he say about those macro indicators and how they're driving the consumer?
And also they've got a great bird's eye perspective because they do have the Macy's brand, but then the luxury items that are from Bloomingdale's. Look, he's not confident about a consumer right now, more broadly. They have been saying there's kind of, to use their turn of phrase, slightly managing decline of the consumer at the moment. People are pulling back. They do want, interestingly, as Andrew was saying, worrying about hospitality, he still thinks money is going to be spent in a more environment of what you're going to be doing, how you're going to be experiencing, rather than your discretionary purchases that everyone has sort of been out there and already doing it. So they are having to be deeply aware of the student loans and the inflationary pressure that, even though it is easing, is still really crimping people's pockets. So he thinks it's going to be all about having to be a gift-giving experience. It's not going to be about your everyday splurging at the moment, and he is really cautious about a US consumer. They're not as, and so therefore it becomes a market share game. And I think it's interesting, I sort of asked him off camera, really what he said, I haven't managed to do everything on my to-do list that I wish I'd done as a CEO, because remember, this is his last ever Black Friday. He's been at Macy's for more than 40 years. He was CEO since 2017, and he's stepping down in February. He didn't do everything he wished he'd done. What he wanted to do was bring more market share and actually drive up like-for-like sales. Like-for-like sales are down at the moment for Macy's, but they are managing to just control their costs and their inventory, so it becomes basically an operational game rather than a profitability and overall sales revenue increase game.
Yeah, we know the inventory challenge has been one retailers have been facing pretty much across the board for the last several years. Thank you so much to Bloomberg Technology co-anchor Caroline Hyde and Andrea Felstead of Bloomberg Opinion. We really appreciate it. And of course, we will have Caroline's interview with Jeff Gennette, the CEO of Macy's, for now, later this hour. Coming up, we'll get more on our question of the day. What are you buying? Art Hogan, Chief Market Strategist with B. Riley Wealth, joins us next. This is Bloomberg. Investors have lots to be thankful for.
The rally we've seen in equities.
Equity rally.
Classic year-end rally.
The holiday rally is certainly very much in force.
An economy that's looking pretty good globally, and risk sentiment that's picking up.
We're seeing this kind of soft landing celebration.
The market that is very enthused about a soft landing.
Inflation coming down.
Inflation which has come down.
Some of the heat cool in the labor market.
The labor market showing some cracks, but simply normalizing.
The Federal Reserve is done.
The Fed on hold.
So far, the Fed's making this look as easy as pie.
The probability of a soft landing has gone up materially.
All the things are moving in the right direction.
Market's moving in the right direction.
But it doesn't mean we should take them for granted. Those are some of our guests on Bloomberg Television weighing in on the market rally, which leads us back to our question of the day. What are you buying? Let's bring in Art Hogan, Chief Market Strategist at B. Riley Wealth. So Art, I guess this question kind of goes two ways considering it is Black Friday. First question is, Are you shopping today? Second question is, what are you buying in terms of actual financial assets?
Yeah, I am absolutely going to help jumpstart the economy on Black Friday, and I've got my eyes on a couple things at Lowe's. So clearly, I think that when we think about what you should be looking at in the market, and it's already started to manifest, is that we've had this underperformance of small cap, and I think that starts to broaden out. I think that's really important to look at. So when you think about the S&P 500 cap-weighted index up about 18% on a year-to-date basis, equal weight up about 7 or 8% on a year-to-date basis. So Russell 2000 is basically up 2%. It's 10% off this year's high, but it's 26% off its all-time high. So clearly, the gap between large cap and small cap hasn't been this wide since 1999. And I think there's a real opportunity for some mean reversion here, and I think we start to see that into the end of the year, into the first quarter next year. That doesn't mean you have to give up on the S&P 500. I'm just telling you that the relative value game right now likely shows up in small cap, and I certainly think that's going to be an exciting time. We haven't seen that in a while. And the biggest headwinds for the small caps have clearly been things like interest rates, which seem to have plateaued and come down significantly. I certainly think the dollar having come off its peak pretty nicely, and energy prices stabilizing here at, they call it $75 level, all positives for the Russell 2000, which largely domestically focused, and I certainly think see a significant rebound.
Good morning, it's Guy. What do you think does better in 2024? Stocks, regardless of cap, or bonds?
Guy, that's a great question. It's one we get a lot this time of year, and I will tell you this may well be one of the best years for both. Coming into 2024, I think you have an opportunity for the 60-40 portfolio to work for the first time in 3 years. I certainly think on a relative basis, stocks do a bit better, but I think having that balanced portfolio, that 60-40 portfolio is going to be the best way to navigate 2024. So it's not to not to dodge your question, Guy, but I certainly think for the first time in quite some time, you have the opportunity to make money on the fixed income side of your portfolio, and I think equities continue to have a lot of room to run.
Okay, so I'm guessing that you think both stocks and bonds can do well because the Fed is not going to be tightening aggressively like they were for the entirety of this year pretty much. I just wonder if both bonds and stocks are doing that well, and by extension financial conditions are actually easing, that ultimately it means by the end of next year we're singing a very different story because the Fed might not be able to ease up.
Yeah, Kelly, that's such a great point, but I would tell you this. I think the Fed eases up when they feel that they are too restrictive with the Fed funds rate. And at 5.5, we suspect by the first quarter of next year, you're likely to see a PCE, which will get reported next week. By the first quarter next year, likely it's going to have a 3 handle at the core, significantly getting close to that asymmetric 2% target. So the Fed typically likes to have 150 or 200 basis points between the Fed funds rate and their target inflation rate, which basically would be the core PCE. And I think by the first quarter, they're going to find themselves being too restrictive. So I think they're going to be cutting rates for the right reasons. I don't think it's going to be 100 basis points in cuts, which isn't consensus right now, but at least 50 basis points in cuts. And that typically will be a tailwind for both the economy and certainly for equity markets.
What's the risk? What's the risk here? What you're describing is a soft landing scenario. The Fed can cut for the right reasons. The economy doesn't suffer too much. It looks like a soft landing right now. Do you, in your heart of hearts, believe that is going to be an easy thing to achieve? Is that what ultimately gets delivered in 2024?
I think the concept of the soft landing versus what we've actually gone through, which has been a series of rolling sector recessions, it sort of stand at odds with themselves. So think about the fact that we clearly had sectors in the U.S. economy that went through their own individual recessions and are likely coming out now. Manufacturing is likely the biggest one of those, and I think that's clearly a positive. So I think that what goes wrong is if in fact the Fed, which clearly isn't going to start cutting rates too soon, and certainly they've been very clear on that. The biggest mistake they could make is to start cutting rates too soon and have inflation reinvigorate. I don't see that happening. I think our biggest concern right now would be China not being able to stimulate their economy, so the demand for goods and services globally from China likely will be less than we're used to, and the pace of global growth is a lot slower than we're anticipating. Another piece of the puzzle might be some disruption, or OPEC really digs in their heels and we go from the average closing price of $77 on oil this year back to $88, which was the average last year. I certainly think that'll be a drag on a lot of things. Neither one of those is our base case, but I would certainly say those are two things to keep an eye out for. OPEC getting really aggressive as energy prices have really calmed down, or China really struggling with the reopening process.
Thank you for joining us on Black Friday. I'll leave you to your shopping. Thank you very much indeed for your time this morning. Art Hogan, Chief Market Strategist at B. Riley Wealth. Still ahead, a labour dispute at 7 repair shops in Sweden spreading. Putting the brakes on Tesla's operations in the country. Apparently, the post is not delivering the license plates in order to deliver the vehicles. It's got to that point. We're going to find out what's happening here. It's in the startup. It's next. This is Bloomberg.
It's 20 past 7 on the West Coast, so let's get to the startup where we cover the top tech stories from the Bay Area and beyond as Silicon Valley starts its morning. And today we're going well beyond Silicon Valley to Sweden, where strikes are affecting Tesla. Joining us now from Sweden is Bloomberg's Jonas Ekblom. So Jonas, just walk us through what exactly this labor dispute is and the impact it is having on Tesla. Elon Musk calls this insane, and that's a quote.
Exactly. So it all started a month ago when, so Tesla has seven repair shops, like Tesla branded repair shops in Sweden. And the Industrial Workers Union want to unionize those workplaces. So they went out and pulled their members out in a strike. And that could be one thing, but the thing is, like, this has spread further because there's 9 other unions joining behind, because the Swedish labor union movement has very wide-ranging rights to go into sympathy action and strikes to punch or attack their labor market opponents and force them to the negotiating table.
In terms of, therefore, how this gets resolved, we understand that Tesla is saying they will not negotiate, that there's little room for negotiation because Musk is saying that is the case. He's calling it insane, but he needs to fix it. So how does he fix it?
It's a big question. A parallel we can draw is actually with Toys R Us, the toy retailer. They came to Sweden for the first time in 1995, and for the first couple of months they refused to unionize their workplace as well, and sign what's called collective labor collective bargaining agreements. And but after a while, for example, like the Swedish unions, they stopped to collect their trash, stopped with like deliveries of toys and whatnot. The same thing happening to Tesla right now. And after 3 months, Toys R Us balked and did sign a collective bargaining agreement and unionized. Whether that's going to happen to Tesla, that's another question.
Well, so it kind of raises the question of what exactly the issue is with the labor side here, what it is that they're trying to achieve, and how realistic it is that everybody's going to be able to come to a compromise here, knowing Elon Musk isn't exactly known for being super union friendly. There was a lot of conversation around the UAW's potential impact on Tesla and him getting a little bit nervous about that.
Correct. And I think experts I've spoken to have like almost like cast this as a very existential question for the Swedish labor movement, a very traditionally extremely strong one. Back as late as like the 1990s, like 90% of all Swedish like workers were like member of a union, and like still to this day, 90% of all employed people in Sweden work in a workplace where they have a collective bargaining agreement is very much the norm. So when big, well, like in this case, American companies come in and like try to break away from that norm, that annoys a lot of people. And the thing is, like, the Swedish model is very styled on these very like voluntary collective bargaining agreements that everybody is kind of agreed to. For example, we don't have a stipulated like minimum wage, for example. Like all of that is like really regulated between the employers' organizations and the unions. So when like some company wants to stand outside of that, that like brings a lot of issues.
Yeah. Jonas, fascinating story. We'll see who cracks first. It's going to be interesting to see whether it's Musk. Jonas Ekblom joining us from Sweden on this story. We're going to be back to retailing pretty soon. Holiday shopping season officially kicking off. I think it kicked off last week, but anyway, we'll park that one for the moment. It is Black Friday. Our conversation with the Macy's CEO next. This is Bloomberg.
We're about an hour into the U.S.'s Black Friday trading session. Simone Foxman is tracking the moves. And Simone, no surprise, but volume is incredibly light.
Yeah, I suppose if you were to use an expression to describe today's trading, it would be nah. S&P 500 flirting with gains and losses all morning. We're roughly flat, though. We are looking at a 10-year yield that is moving higher. And frankly, if there's anywhere where we're seeing some activity, it's in the bond market, biased towards the long end of the curve. We're seeing some movements across yields there. We are also continuing to see the Fed story play out in gold and the U.S. dollar. Gold here has been up for 5 days. We're also looking at a weaker U.S. dollar as traders look to potential rate cuts next year. They are largely expecting the end of the rate hiking cycle. If we flip up the boards, we'll see another expression as just sort of how blasé we have been in markets amid the broader S&P 500 rally. We're looking at the VIX slightly higher, but if it closes lower, this will be the lowest since January 2020. It's the 5th consecutive session. It would be the 5th consecutive session that it fell. It did fall to 12.75 earlier today, but we can see slightly up today. If we're looking for also some activity in the stock market, well, there are some movers. One big one, iRobot. Reuters reporting that Amazon will receive approval from the EU to move forward with its acquisition of the Roomba maker. Amazon shares, though, not trading in tandem with iRobot, perhaps because we are seeing strikes across 30 countries by Amazon warehouse workers, including the U.S., the UK, and Germany. A spokesman in Germany did tell the Wall Street Journal, though, that it doesn't expect any hit to overall deliveries. NVIDIA shares moving lower as well. This on a different report from Reuters that Chinese chips that are going to be sold, the new Chinese chips, will likely be delayed till the end of the first quarter. And finally, we are watching shares of Tesla. They are moving higher after some losses into the pre-market after news that BYD could potentially cut prices of its rival electric vehicles. That could potentially take away some market share from Tesla. Again, iRobot, I think, really the name moving this morning. Guy.
Absolutely. As you say, quiet elsewhere. Simone, thank you very much indeed. Let's return to the retail narrative. Therefore, Macy's says online sales for Thanksgiving have gotten off to a strong start. Bloomberg Caroline Hyde spoke with CEO Jeff Gennette from Macy's flagship store at New York's Herald Square.
They're buying everything on their gift list, and they're buying, that's really generally in luxury. So fine jewelry, they're buying cashmere, they're buying outerwear for the entire family. Hostess gifts in our home store, but they're also home prep. We've got great deals, as we always do for Black Friday, going all the way through the holiday season. So we are ready. We've got all of our key items, loaded to bear. Here we are in Herald Square. It was a good opening. We had a great day online yesterday during Thanksgiving.
I mean, you said that on your earnings, which were, about a week ago.
Yes.
So this gets earlier and earlier.
It does.
Black Friday, the competition. How important are the next few days and the run-up to the holidays?
Oh, it's still very important. So, when you think about kind of Black Friday deals really started it right after Halloween is when they started. But this is still a pilgrimage. You've got, America is traveling and they are in homes and they're coming into stores just like this one today. They're online. They've been online all the way through. So it's very, very important. So when we look at kind of Black Friday through Cyber Week, then we go into a lull. It's like 10 days where people kind of reset, and then those last 10 days become increasingly important. So it's one of the 3 stages right now that we are at the kind of the Christmas shopping is the one we're in right now, the first.
What, of course, your earnings showed so clearly is that it's about inventory management in many ways for the moment, and you've been managing to ace that. How are you ensuring you got the right thing in the right time for a consumer that basically we're all trying to understand right now?
So obviously the consumer's under pressure, but they still love gifts. And so we want to make sure that we've got all the right gifts and we've got all the right stock content in them. So I just walked this entire store to really understand where we are in all of the content across all of our categories, and we're in great shape. And that's really in tribute to the amount of work we've been putting in inventory control.
And when it comes to online versus in-store, in retail, this is how you've been shifting the company. In particular, people aren't perhaps having the footfall in malls. They're coming to one-off stores. They're going to smaller store experiences. But e-commerce has just been the focus. How are you managing to be at the right time in the right place for an omni-channel purchaser?
So really, the strength of Macy's and Bloomingdale's and Bluemercury is that we're omni-channel and we're omni-category. So what you have is you have customers that are shopping online, they want to come into a store and try it on, and they maybe are transacting on the couch later that night. So the opportunity to make it as convenient for the customer as possible, however and whenever they want to shop. So that's our beauty, and doing that with a national footprint, with a great website, is what we depend on.
And of course, why you've got such a great bird's eye perspective, because you do have Bloomingdale's for the higher end, more luxury purchaser, and then more income breadth when it comes to Macy's. What are we seeing in terms of the consumer? Are they going to be spending more? Are they going to be pulling back?
So you do have customers that are under pressure. And so when you think about the inflation is still high, it's abating from the change of the inflation rate from last year, but it's still higher than it was last year. And customers have got a limited budget. Some of it is they're spending it in experiences and then in our discretionary categories. So we want to make sure that we've got the right price points across that entire spectrum. But you still give gifts. And this is where Macy's and Bloomingdale's and Bluemercury shine. So when you have this gift, somebody on your gift list, we're going to have the right content for you at the right price point. And we spend from when Black Friday ends to where we are right now. We've been spending a year getting ready for that. And we do trial runs on Valentine's Day, Mother's Day, Father's Day to make sure we've got the right gifts. We're ready.
You're ready. People are worried, analysts might be worried that you're kind of managing decline at the moment. What would you say to a comment like that?
Look, I think that if we weren't a department store today, we would invent one. So the idea about having multi-categories, being able to do that in multi-channels, we now have been able to get new categories in as a result of Marketplace, which is now online at both Bloomingdale's and in Macy's. So I bet on department stores. And obviously I made my career doing this. And it is it's still very, very relevant. We're obviously looking at where traffic is moving from on-mall to off-mall. We're obviously testing that in both Bloomingdale's with the Bloomies format and with Macy's And so we're going to be ready for where the customer is evolving. And we've got very strong assets to be able to do that, both on-mall and obviously online.
Evolving into a world where we're all using chatbots and artificial intelligence at front and center, are these the sort of areas of investment?
Yes, absolutely. Because when you think about AI and machine learning, think about when we have 40 million customers at Macy's, 4 million at Bloomingdale's, we know them very well. So to have all that data and be able to start to personalize content and values for those customers is where this is all going. How do you make your brand more relevant? And that is at a customer level. It's no longer broad-based promotion. It's the opportunity to be able to, I know Caroline, and based on what you buy, what you might be interested in, and to be able to serve that up in the way you want it served up is really the secret of success for an omnichannel retailer going forward.
You, of course, just mentioned throughout your career this is what you've been doing.
Yes.
For those who don't realize, you've worked at the Macy's brand for more than 40 years.
Yes.
And this is your last Black Friday.
Yes.
And of course, CEO since 2017. You have been thought of as a turnaround focus, the polarist, the way in which you have thought about personalization to e-commerce. You weathered, of course, the COVID in and of itself. Do you feel that you've got the Macy's where you want it to be as you look towards this being your last Black Friday?
Yeah, look, when I reflect back on my career, and certainly in my time as CEO, I didn't accomplish everything that was on my list. But look, the focus on relevant content, on amazing values, and on customer experience is clearly the path forward, and I couldn't be more excited about my successor, who is more than ready to be able to do this. He knocked the cover off the ball with respect to Bloomingdale's and what he was able to do there, how he was able to kind of help turn around the strategy of Bluemercury. He's now going to do that for Macy's Inc. So he's got a good game plan, and he's going to make it better.
That was Macy's CEO Jeff Gennette speaking with Bloomberg Technology co-anchor Caroline Hyde. And you can follow Bloomberg's coverage of Black Friday on our T-Live blog on the terminal. Now coming up, we're going to turn to what is going down next week, maybe once all the holiday shopping is over. It's going to be about OPEC. Watchers of the cartel are seeing an increased chance of deeper production cuts. Christian Malik of JP Morgan was in Vienna right around the time that OPEC Plus announced it was pushing the meeting back. He'll join us next with more on what he heard and what he thinks will happen next week. This is Bloomberg. The United States Oil Fund, one of oil's biggest ETFs, the ticker USO, registered its largest daily withdrawal in almost 7 years, just days before the OPEC Plus meeting. And of course, Guy, it was earlier this week when we first started getting reports that the meeting was going to be delayed. There was some disagreement, we understood, over production and what levels should look like among all the different member countries. You saw a big decline in oil. It feels like we've stabilized a little bit, but largely this feels like a market that is very nervous for what happens when the meeting comes next week and whether or not they actually will be able to get around a deal.
I think you want to pay attention when Saudi starts throwing its weight around, and we obviously got the technical readouts of the review that had been done of production in countries like Angola and Nigeria. Saudis clearly felt that they had to make their opinions felt. They did it in a very forceful way, and I think the oil market sat up and paid attention. What happens next, I think, is fascinating, Kayleigh. What kind of a year are we going into in 2024? What's the demand picture ultimately going to look like? We've been very focused in 23 on the supply side. Does that flip into next year? So yeah, I think those huge the ETFs are used as a way of playing this on a macro basis. So I guess it's understandable that you would see those kinds of withdrawals given the scale of the move we've seen in crude. Let's get another take on this from a man who was actually at that meeting that wasn't. Christian Malek, JP Morgan Global Head of Energy Strategy.